Okay, you also get hedging lines. Also go through this rather quickly. So your hedging lines, they're used for derivative products that allow companies to fix an exchange rate, commodity price, or crucial input costs such as fuel for a stipulated period. Okay. So in other words, we'll see this when we do our case studies. You want to fix the cost of a commodity because you believe that the commodity price has got price instability in the medium term. So you're happy with where the forward curve is now, so you want to lock in the price of copper, for instance. Or you believe diesel is going to run sky high, so you want to fix your diesel costs. So you'd use derivative products, options, futures, forwards, in order to secure a fixed price for the medium term, short to medium term, even long term, but that becomes expensive. So hedging lines suitable for companies that have achieved reliable production levels and who sell hedgeable commodities. Okay, can be used as a deal sweetener. For example, banks like Macquarie and somewhat as I saw in First Quantum, the banks made their money on the hedging, not the actual debt. So we struggled because when we were marking lines against a company like First Quantum, we rated them differently than the international banks. The international banks gave them a higher rating than we did. And because we gave them a low rating, we had certain portfolio threshold limits. So we couldn't provide them with huge hedging lines because that's too much exposure for our balance sheet. So unfortunately for us, we can't make as much money as the Soc Gens, or I forgot who was the major. Stanchart was big at one point. But they made their money offering very cheap margins on First Quantum amortizing facilities, and they made their money on the hedging side. So I know Macquarie specializes in this business model where they provide very cheap debt, especially to junior mining companies, and they just price us out of the market for these African junior miners. But they stipulate that the company needs to hedge whatever 30% of production, and they really charge really good margins on the hedge. So you don't hedge at the forward price. If let's say the forward price is $100 an ounce for whatever, or whatever, maybe gold 1,700, you would offer the client, in theory, 1,700 as the forward curve, but then you'd build in a margin. So the client would have to pay you a margin, and then the net price that they get maybe 1,650 or something. So those margins, depending on how wide the margins are, is your profit that you'd get as a hedge provider. And a lot of banks make a lot of their money on the hedging lines. And for us, we would use it. Let's say we're making a return on capital of maybe 10% on the debt, but the hedges gave you a return on capital of 30% and you split that with the global markets guys, then you could say that overall on the deal, you cross your threshold, whatever that is now. So it was 20%, then it became 15%. So you can cross that threshold if you provide hedging for the client, and the hedging is quite rich.